Alright, ICT traders, welcome back to the channel. I want us to do a very quick recap on how to approach the market using ICT top-down analysis. Now, it is important that you know how to approach the market using top-down analysis because there is no any single strategy out there you can use that doesn't respect top-down analysis. In case you've been trading any particular strategy and you are seeing result, it is probably because you are ignorantly trading with the smart money using top-down analysis unknowingly, or you are doing it with the knowledge of top-down analysis. And that is the only reason why I insist you do your top-down analysis every time, so that you have an idea of where the smart money are taking liquidity or where price is delivering liquidity. That is a simple reason why you need that. So let's get into that briefly right here. What exactly is top-down analysis? I've said that time and again, that top-down analysis is simply you having that ability to look at the market from a higher time frame and then break it down into crunches into the lower time frame and have your entry right there, because the smart money are actually residing on the higher time frame and then they don't view it with the smaller time frame perspective. So you have to go into the higher time frame and look at what the smart money are looking at, and then drop down into the lower time frame and execute the same thing. Now, this is an example I always give people about top-down analysis. Let's take this circle for example. Let's say this very big circle is our higher time frame. We can call it the weekly time frame, the monthly time frame, or the daily time frame. I always encourage people that are trading intraday to focus highest on the daily time frame. So if you're trading intraday, you're going to focus on the daily time frame as your highest time frame, or probably the 4-hour time frame. All right, that is the time frame you're going to be focusing on, and then you drop down to the lower time frame and execute your trades. That is the best way to do it. I'm going to simplify it right here in this video for you. So this is our daily time frame as a very big circle, and then want to break it down into a lower time frame. Now let's say this other circle is the 4-hour time frame, and then want to break this 4-hour time frame into another circle. Let's say this is a 1-hour time frame. All right, you can see you can go on and on, breaking it down, breaking it down, breaking it down. Now this is the idea behind the top-down analysis. You'll be able to go into the core of this circle and pick trade to target each of these levels. If you have a particular liquidity level in this time frame, you can target it. If you have it here, you can target it. If you have it here, you can target it. And with this simple understanding, you can even do what is called positional trading, taking a trade that you will last in the trade for a month, for 2 weeks, 3 weeks. All right, so let's get into it in detail. So looking at this, as I said earlier, we're going to focus basically on the daily time frame and the 4-hour time frame as our higher time frame, where the big boys are residing. Since we're trading intraday and taking out everything right here, let me delete everything right here so we can get into that. So this is it. Now, when it comes to selecting the data you're going to use, it's also troublesome to a lot of people. All right, so I will always encourage you to look at what is happening, the most recent price action, what we have right here. What are we seeing from the most recent price action? That is what you should be focusing. Now you can actually see that price had moved to this level, coming back, and then there is a shift in market direction completely from here. What price is doing basically is that it is trying to reach out to every single level there is liquidity. What is liquidity? Liquidity in simple terms is simply where money is. All right, because the first time you hear about forex trading, you actually came into the market because you wanted to make money. Likewise, the big boys that are in the market are also looking for money. So all these places are filled up with money, money, money. So I want you to start viewing every low or every old high as where there is money. This money is in form of buy stops and then sell stops. So every place you see these relative equal lows, relative equal highs, there are basically places where there is money. All these places. All right, I hope you're watching this carefully. So as price is coming, where is it going to be targeting? All the places where there is money. If it picks money, it goes back inside to reprice, push again to pick money, go back inside to reprice, pick money, and go back inside to reprice. So that is the only reason why you saw price actually pushed below here. Can you see this major low? Price pushed here, repriced, and then is pushing again, trying to reach out for the money here, then pushing out, trying to reach out for the money here, then it will push down to reach out for the money here. So this is the only reason why we think this market is going to keep going low, low, low. And then since we know that price is going to the downside, what is that bias? It is a sell bias, or what I call the seller's territory. There are basically two types of territory: the buyer's territory and then the seller's territory. For a buyer's territory to start, you must be able to see this one. Please be patient and watch this to the end, because I need time to explain this to you in detail. So you look at this, you see price going up. This is how price goes in a buyer's territory. So if you want to establish a very strong buyer's territory, you want to make sure that the higher low in this regard, the higher low is basically this swing low, is not taken out by this movement. So at any point, if we see this higher low being taken out by this guy, is what ICT calls shifting market direction. So that is a shift in market structure or shift in market direction. And anytime there is a shift in market direction from an uptrend, we're going to have a downtrend. That's basically from buyer's territory, we are expecting to see seller's territory. So that's basically what happens every time you see this movement. So as far as we are pushing up, our bias is going to be, we want to be buying, buying, buying. And that is where the saying that trend is your friend comes in handy. The trend is your friend. You follow where the trend is going. So we look at this. We knew that price is coming down here, and then we are seeing it as a word, as a bearish bias. So what do? We look out for what is the most recent area of price. Price did this, had this break of structure. Forget about any strategy. Do this, and then you will know that the market is actually an algorithm that has been designed to follow every concept that ICT taught you. And you can see it time and again. You cannot benefit anything from the knowledge you are getting if you don't have an understanding of how to approach the market with this simple concept of top-down analysis. So we have this, break of structure to the downside. This is it, break of structure. Then normally if price moves, break structure, picks liquidity at this point right here. It picks the liquidity here, and then you can actually see matching both the liquidity on this side and then the low here. Where is it going to go to? It will reprice back into this area where we call it a premium. Everybody wants to buy anything at a cheaper price, and then everybody wants to sell anything at an expensive price. So if you want to sell, do you feel comfortable selling here? This is too cheap, so it comes here and then you sell because it is expensive. Price, as it goes up, it becomes expensive. So that is the only reason price goes up to that area. But meanwhile, we are still watching it as a sell market. And then I will show you where this thing comes in handy when I drop down to the lower time frame, and then you're going to see how to take trades and take advantage of this movement. So this is it now. If we want to change territory from this seller's bias to a buyer's territory, where is our area of reference? This place. Until this place has been taken out, this market is a seller's market. In the daily time frame, we keep selling. And then let's drop down to the 4-hour time frame and see what we have. And this is where it comes in very perfect. All right, you can actually see what is happening in the 4-hour time frame. So this is it. So as a trader, when you drop down to the 4-hour time frame, what are you watching? Let's assume this was the only thing that happened. Let's see from here. Let's assume this was the only thing that happened. All right, so you can actually see this movement. So what are you looking for? Now you bring in your knowledge of break of structure or market structure to refine everything you have here. You see price coming down. You have this break of structure here, push, another break of structure right here at this point. You saw this break of structure. Then you see price retracing. This is your point of reference. Until you close above here, you are not a buyer. It is not buyer's territory. And then you will mark that area. You will mark that area and watch this area very, very well. It is your reference point. Nothing should make you change your mind about this area. As far as price is here, so this movement, it can do anything it wants to do. It is not buyer's territory, and that is where the idea of counter trending comes in handy. All right. If you hear people saying I'm counter trading, it is basically having this understanding that price is bearish from the overall trend. Let's see, price is bearish, and then this retracement is in 4 hour. This retracement will take long time for it to reach the point of interest. Remember, I told you that everybody that wants to sell at an expensive price. Price will take long to come into the premium, and then this is where people that are counter trading are finding this information. Once they know that price will want to go back up there, where is it going to? This is where your institutional reference point comes in handy. A fair value gap, very small one here, a very small fair value gap. If you're not very sharp, you will not even see where the fair value gap was at this point. Very small fair value gap. So price will want to push up to that place because there is liquidity also above here. So as soon as you want to take this trade as a counter trader, you can simply drop down to the lower time frame also and be trading this. Now there are two ways you can do it. You can counter trade, and then once you reach this area, point of reference or point of interest, this place, a bearish order block, and then this particular fair value gap, you can stop buying. So this is it. Let me show you that. If I go down to the 1 hour time frame, you're going to see what I'm saying. Let's say we want to be buying in this market. We want to be buying. Let's have a little bit of movement like that. Okay, so this is the idea. We want to become buyers. So the sell was here, push, creating this high, and then we officially created this high right here. We have this shifting structure. Please don't be confused with what I'm showing you right here. I'm showing you what will help you. So if you are trading, what are you going to do? You know that price is willing to go up there. This is called repricing model. It's trying to reprice to give you the best place to sell so you can make money. Remember, you came to the market to make money. So the people that have bought here, where do you think they want to sell? Do you think they will sell here? They want to sell when it is expensive. All right. So you are going to take this as a counter trader. As a counter trader, you are going to use whatever knowledge of ICT, after break of structure, market structure shift, to look out for all the institutional reference point. If it is this particular fair value gap you're watching out for at this point, you can confidently wait for it because you want to also make money from there. All right. So that's basically what normally happens in the market. Price never came here, and then price kept on moving to that side. Price never really reached out to this level, and that is why I wanted to tell you that if you are going as a bullish trader in this regard, what you do is that you don't take the trade here. It's too risky. I want to buy it very cheap. So if I don't see price coming down to this place, I'm not going to buy in the 1 hour time frame. I'm not going to buy. I'll just allow it to be because I know I can be patient to wait for price to go to that level. Let me show you that, to that particular level. So in this now, I can bring in any of my strategy, whatever strategy. Is it London hour kill zone or New York hour kill zone, whatever you want to do, you can bring it in right here, very handy, and then you watch it out to play out. But if you want to be patient from the 4 hour time frame and wait for price to come here before you start selling again, it's also fine. So what do you do? As soon as price reached out for this area, what do? You're going to watch out for price to really align with it movement. So if you are trading the 4 hour, 1 hour, this is what you do. If you are trading the 4 hour as your big time and then the 1 hour as your entry hour, this is what you do. As soon as you see price here, and I told you time and again, stop taking trade because you saw price reached out to a fair value gap or another block. Wait for a confirmation. The confirmation comes in always in form of a shift in market structure to realign. This is how the algorithm works. The market is bearish and it wants to align with this from the higher time frame to the lower time frame. It wants to give you that alignment. That is it. So how do? You wait for it. You wait for it to align. Let's see. We are in buyer's territory. Let's see whether it will give us a seller's territory with a confirmation. We have created a low right here. Can you see this one? This is where it comes in handy. We have actually created a low right here. That means we have shifted structure. We have shifted structure in this area. Let's go to market structure shift. we have shifted structure because this was a low pushing up again, failure swing coming down. And in fact, this is an entry. I even forgot to show you this place. This is an entry, a perfect one. So if you want to enter, what do? You're going to enter with this information. You saw price push up, failure swing, pushing up again, and then this is where you have a shift in market structure, or you can just simply leave it there. And where do you think price is going to go to? Price is going to reach out to an institutional reference point. Let me show you. This is a sniper entry model that you can take from here, and you're going to target the opposing area. So if you're taking trade from this, it took you long time for it to come to this place. I don't know what strategy you want to employ to take the trade to this area, if you want to counter trade, but if you be patient for the 1 hour to realign with the 4 hour, you can wait for it to go over. So where are you going to take your trade? As soon as you see this realignment, price reaching out for this level. In fact, price even reached out to this higher level fair value gap. So price did something called an inducement, because relative equal highs attracts a lot of inducement. So above here is where a lot of money is. So price has the potential of pushing above it and even reaching out to this guy. So that is the only reason. And that is why I said you shouldn't be taking trade just because of fair value gap or another block. Wait for this kind of happening, shifting structure in that area. This area is important, we know, but let's see a shift in market structure. Let's see the willingness for price. And then let me show you something. You can also bring in this indicator called volume. It's very powerful, guys. I've shared this sometimes back. This volume indicator is pretty much a very good, indicator that will help you to know where the momentum of the market. Let me change the color. I don't want to alter the color. Let me have the same color on everything, so you can see. So you're going to watch this and see if the shift in market structure or displacement comes in with a very good volume. So you can look at this. As price reached out to this area, the volume actually diminished right here. I think I will take time to make a video explaining volume differently, but look at it. As soon as the shift in market structure came in, volume increased. All right, so it's telling you that there is something that is about to happen. It means that these big boys are about to take the sell from that place, and your stop loss is obviously above here, and that is the only reason why you would target down here as your target. Right, you can couple in. You can see the movement here is heavy, and then the volume increase. As it is coming to the upside, the volume is reducing. Volume is one of the indicators that doesn't necessarily change in printing, or it doesn't repent. That's what other people say. So you can simply use that volume indicator. I will find time to show you that in detail. I think I'm just doing a recap on this top-down analysis stuff. I have quite a number of videos on top-down analysis. So you're going to wait for price to come and take you in, and then boom, you are inside the market. This is a 1 hour candle. Waiting for it to come back takes you time, and then you're going to enter from there, that fair value gap. And that is the only reason why you would take this trade. All right, that is the only reason why you would take this trade from there. You saw price coming back to your point of interest in the 4 hour time frame, then you bring in the lower time frame to watch for retracement. It takes you a long time, but the patience have paid for this thing you've done. The patience you've taken to wait for price to come over here have actually paid you, because you can actually see that the price has given you the movement you wanted to have. I hope this is explanatory enough. So what are you doing now? You're actually doing everything in tandem with the time frame. Remember that cycle? You're jumping from the bigger cycle to the lower cycle to the lower cycle to the lower cycle. That's basically what a top-down analysis. And once you have this understanding, you wouldn't be jumping from here and they're looking for what is the best strategy, how do you enter, how do you do this, how do you do that. Okay, I hope you're understanding this. I'm taking time, but I'm giving you something that will help you in your trading journey. It will help you to become a professional trader. So going further, let's just see how price move again and see if we can get an opportunity to do another example. But basically, you can do this on any time frame at all. So you can do it and see how it works. You can do it the same way this thing happens, time and again and again and again. All right, so go ahead and check any asset at all and do this simple example, jumping from the higher time frame to the lower. It was the daily time frame as the highest, and then I dropped down to the 4 hour time frame, and then I dropped down to the 1 hour time frame. So I was calling this as a counter trading because I knew price is going to go there as my point of interest, because every time the algorithm wants to sell at an expensive price and wants to buy at the cheapest price. That is the basic way the algo works. So if I want to drop to the lower time frame, I will do the same thing. You can see you can drop down to the 15-minute time frame and still have an entry. Let me take you to that place so you can see what I'm saying. I want to just share this with you. I'm taking time, but this is going to explain a lot of things for you. So this is it. This was the place I came to take the trade, right here. I am sure this is the place. So if I drop down to the 15-minute time frame, you are still going to see even a more cheaper entry, that you can take. All right, you can see all this shifting structure, taking trade from there. You can take from anywhere from that place. Even in the 5-minute, you can still see the same thing. So now you're not just taking trade from the 5-minute as a blind trader. You are taking trade with the understanding that the higher time frame is backing you. So this is where you see people taking trade in 1-minute time frame and then having a very huge reward. You can take the trade in any of this time frame. Even here is a place you can take trade. Look at this, a shift in structure, or what they call a break of structure right here. Then price coming back to this mitigation block right here, a mitigation block right there, and then you can take from here. And this is even a very small what is that, risk to reward. The risk is very small because your stop loss is obviously going to be above here. That's about 10 pips or thereabout, more than 10 pips rather. Let's see, about 12 pips or thereabout. So this is how these things work, guys. If you have any question, let me know in the comments. I will keep repeating this time and again and again and again on different assets so you can know how to do this by yourself. I don't have to go back into doing it by the time you all learn how to do top-down analysis. Thank you guys for watching. Give this video a like, and I want you to subscribe to this YouTube channel, obviously, so we can grow and have bigger community. And you can also join my Telegram community. The link is in the description of this particular video. Go ahead and do that. Thank you guys for watching. See you in another video.